All right, let's just get right into it. The housing market today, it's a total mess of mixed signals, right? Is it crashing? Is it booming? It feels like nobody can agree. While it's confusing, it's definitely contradictory, and in this explainer, we're going to make sense of it all. So, first things first, let's just lay out this central puzzle. On one hand, you hear all this talk about a massive crash. But on the other, you're seeing prices in some places just keep going up. So let's break down exactly what those conflicting signals look like. So you've probably seen the headlines, right? For the first time in nearly 2 decades, national home prices are actually on a downward trend. That's a huge deal. But, and this is a big but, that is definitely not the whole story. And this is where it gets really weird. I mean, look at this. You have nearly every single major city getting weaker. You've got way more sellers than buyers, by a lot, and homes are just sitting on the market longer than they have in a decade. But at the exact same time, you've got cities like Milwaukee where prices are soaring by 10%. How can both of these things be true? Okay, to solve this mystery, we have to look at the one thing that's crushing pretty much every potential home buyer right now: affordability. This right here, this is the key that unlocks the whole puzzle. Yeah, everyone knows high mortgage rates are the obvious problem. But what most people have no idea about is that there's this hidden factor, something you see every single day that's secretly making the situation way, way worse. And here it is. Believe it or not, it's oil. It's a crazy chain reaction. When the price of oil spikes, big-time investors get nervous. They demand higher returns on super safe stuff like government bonds. That, in turn, pushes up the yields on the 10-year Treasury note, which mortgage rates are directly tied to. So yeah, the price you pay at the pump really does have a say in your home loan. Wild, right? And here's what that actually means for your bank account. This is just brutal. Look how fast the income you need to afford the exact same house just explodes as rates go up. A jump from a little over 4% to just over 7% means you suddenly have to be making an extra $26,000 a year for the same house. And get this, just a tiny quarter-point increase in mortgage rates, something you'd barely even notice, is enough to instantly kick 1.4 million potential buyers right out of the market. That is like the entire population of San Diego suddenly being told, nope, you can't buy a home anymore. The market is on an absolute knife's edge. So, okay, with all that pressure building, what happens next? This is where we get to what's really going on behind all those scary headlines. And trust me, it's not what you think. It all comes down to this really important idea called a real terms correction. So instead of this dramatic 2008-style crash where prices fall off a cliff, what happens is prices just stall. They go sideways. They grow way slower than your paycheck does, giving everyone's income a chance to catch up. It's actually the healthiest way for a super overheated market to get back to normal. And Redfin has the perfect name for this whole thing: the Great Housing Reset. This quote really says it all. For the first time in more than a decade, your income is actually expected to grow faster than the price of a house. That's a fundamental shift that slowly but surely closes that massive affordability gap. And this just proves why you can't trust those national headlines. We're truly living in a tale of two different housing markets. More affordable places like Milwaukee are still hot, but the pandemic boom towns, like Austin and a bunch of cities in Florida, they're finally seeing prices come back down to earth. Now more than ever, your specific zip code is what really matters. Okay, so the market is slowly trying to fix itself. But what about the government? Can they step in and speed things up? There are a ton of ideas being thrown around in Washington, so let's take a look and see if any of them can actually work. All right, proposal number one is a big one. The government steps in and buys up $200 billion worth of mortgages. The idea is, if the government becomes a huge buyer, that extra demand should help push interest rates down for everybody else. But here's the reality check. 200 billion sounds like a massive number, right? Well, in the grand scheme of things, it's just a drop in the bucket. It's only 1.4% of the entire mortgage market. It'd be like a one-time sugar rush with no real lasting effect. Next up is an idea you've probably heard a lot about. Just ban the big Wall Street investment firms from buying up single-family homes. Leave more houses for regular folks. On the surface, it sounds like a fantastic idea. But when you actually dig into the data, it turns out this is kind of a solution looking for a problem. These big investors, they only make up less than 1% of all buyers. So banning them, as satisfying as it might sound, would unfortunately have almost zero impact on prices for the rest of us. Okay, now this next idea is pretty interesting. What if you could make mortgages portable? So if you've got one of those amazing 3% mortgages from a few years ago, you could just take it with you to your next house. This would get a lot of people who feel locked in by their low rate to finally sell. But here's the massive catch. For banks, this would be an absolute financial disaster. They'd be stuck holding these super low-yield 3% loans for decades longer than they planned, leading to what they call huge irreversible losses. So great idea for homeowners, but it's a total non-starter for the banks. And finally, we have the supply side solution. Just build more houses. Specifically, build affordable housing on all that extra land the federal government already owns. Now, this is actually a really promising idea. The only problem is the timeline. From the moment you get approval to someone actually moving in, you're talking 5 to 10 years minimum. So it's a great long-term solution for sure, but it does absolutely nothing to help the affordability crisis we're in right now. All right. We've seen the crazy contradictory problem. We've found the real cause, and we've looked at why the proposed fixes probably won't work. So what's the bottom line here? What does this all mean for you? Here is the final verdict. Based on everything we've seen, we are not heading for a 2008-style housing crash. There's just way too much equity and way too much demand for that. But, and this is the most important part, the era of easy money in real estate is officially 100% over. Gone are the days when you could just throw a dart at a map, buy a house, and watch it double in value. The game has changed. Fundamentals matter now. Your location matters. Your long-term plan matters. The easy mode has been turned off. So the real question is, are you ready for what comes next?